Welcome, everyone. We have some big news to get into. The time for easy money, right? The cheap money, the low interest rates, the companies being able to borrow and get liquidity and capital to be able to fund their non-profitable businesses for prolonged periods of time, that might be coming to an end. This time that investors have enjoyed of markets being propped up by the Fed with a low interest rate environment, with the Fed buying everything left and right, propping up bonds, propping up equities, that might be coming to an end a little bit quicker than anticipated. Janet Yellen, which is the Treasury Secretary, she strayed from the script, okay? The script is that the economy's growing, the unemployment rate's coming down, and the economy's booming, right? Everything is going really well, and that's causing some mild inflation, a little bit of overheating, but we don't have to worry about that. That's really not a big concern, and we're definitely not going to raise interest rates. That's been the script. Jerome Powell has repeated it. Janet Yellen has repeated it, that inflation is not a concern. It's not a concern now, and it's really not a concern in the future. And if it does become a concern way down the road, then we do have the tools to deal with it, but we'll be patient. We won't employ those tools right away, right? And those tools meaning we won't raise the federal funds rate. That script seemed to have changed overnight. We have this news right here. Treasury Secretary Yellen says just an hour ago that rates may have to rise somewhat to keep the economy from overheating. This is the first time that either of them, Janet Yellen or Jerome Powell, has strayed from that script of interest rates not having to be raised. Now, why is this important? Why do the markets care about this? First of all, they care about this news a lot. That interest rates might go up, even the suggestion that they might go up. Look at the effect this has on the markets. Everything's in the red, and this isn't mildly in the red. We have the Dow Jones down 0.44%. We have the S&P 500 currently down 1.13%. So over a full percentage for the S&P 500. And then the companies getting hit the hardest are the ones that are the biggest beneficiaries of low interest rates, which are technology-funded companies, ones that are high growth, but they're relying on that easy capital, which is the NASDAQ. It's down 2.45%. So we're going to be looking at all of this. I'll be giving my thoughts on Janet Yellen's statement here of her suggestion that interest rates might have to raise, what this means, how this is a complete left turn, right? This is a complete change in direction of the way that the Fed and Janet Yellen were previously talking about the economy and talking about interest rates. They had made quite clear that they were not raising interest rates. And they did that to instill confidence in the investor. Now that that confidence is being lost, well, you can see the effects that that's having on the market. So I'm going to be going over this news, talking about Janet Yellen and her diversion from the path of interest rates staying the same. I'm also going to be giving an update on the Story Fund. As you can see, the gains are vanishing. People are selling out of these companies, even though I think this is a portfolio of high-quality technology companies. Investors want nothing to do with them right now. They're headed towards the exits, and I'll be talking about that as well, what I'm thinking going through this, what I think with the portfolio, and the direction I plan on taking it in the future. So we'll be going over that as well. So starting off, I want to talk about the big news, which is this story right here, that Janet Yellen, and I think they used the correct language here. They used the correct word. She conceded. Why do they use the word conceded? The reason that she conceded that interest rates might have to go up is because this is kind of like the elephant in the room. Everybody that has lived in the past year, that has purchased anything, has visibly observed inflation. We've all seen inflation happening. Can you name anything that really hasn't gone up in price over the past year? Pokemon cards, they've gone up in price. Crypto's gone up in price. Every type of asset, right? We have stocks, bonds, real estate, anything that can even be considered an asset. And then outside of just investment assets, you have housing, real estate, you have lumber, steel, you have every type of commodity, any type of grocery store item, paper towels, toilet paper, all of that's going up in price. Gas is going up in price. Everything that people do, everything where they go and they drive and they buy things and they consume things and they enjoy their life, most of what they're doing is going up in price. So even though the government so far has said that inflation is minimal, we're not really seeing inflation, most people are thinking to themselves, how are they saying this? Everything is going up in price rapidly. A lot of things are increasing in price dramatically over the past year. $100,000 could buy you so much more 1 year ago than it can this year. Think about how much more home you can get with $100,000 a year ago than just 2021. They've gone up steadily in price. So we've all personally seen examples of inflation. I'm sure you guys know examples yourself. It's easy to find anything that's gone up in value over the past year like crazy. If you want more examples of that, by the way, if you want to see a lot of evidence of that specifically with companies, you can check out the previous video I did on my other channel. I'll put a link in the description. But there's plenty of examples of inflation. Everybody's seeing it, but that's a problem for Janet Yellen and Jerome Powell because so far they have maintained that inflation really isn't happening to any big degree. It's kind of normal, like 1% to 2%. And even if inflation does happen, we're definitely not going to raise interest rates. We're not raising interest rates. We just want to make that abundantly clear. We're not even thinking about raising interest rates. That's the language that Jerome Powell has been saying for the past 6 months, repeating it over and over again, example after example. We're not even considering raising interest rates. In fact, if you want to see just one example, we can look at one here. This was back 6 months ago, okay? Just 6 months ago.
We're not even thinking about raising rates.
He says it 3 times there. That's a triple, right? Usually he says it twice. He said it many times. We're not even thinking about raising interest rates. But this time he said it 3 times just to overemphasize the point to investors that there is zero chance in any time in the near future that they're raising interest rates. You can listen to it again.
We're not even thinking about raising rates.
Okay, so 6 months ago, that was the messaging to investors. That was the messaging to investors and to the economy, is that money is going to maintain this easy path, right? It's going to be easy to get access to capital. Interest rates are going to be low. The economy is going to continue to boom. We'll get unemployment rate down. That has been the messaging, that there's no chance of raising interest rates. And then just a few months later, a short time later, we have concessions happening. Janet Yellen saying, well, we might actually have to raise interest rates. Her specific language was, quote, it may be that interest rates will have to rise somewhat to make sure our economy doesn't overheat. So that's the messaging now, that our economy is doing so good that we don't want it to overheat, so we may have to have some interest rate rises. She goes on to explain that this is worth it, right? It's worth what we're doing right now. It's worth all the spending to have some inflation. She says even though the additional spending is relatively small relative to the size of the economy, it could cause some very modest increase in interest rates. That's a little bit of a change of messaging. Again, for month after month after month, Jay Powell and Janet Yellen have been saying, we're not even thinking about raising interest rates. And then here we are saying, well, we might see some modest increases. So a complete change in direction. And why do investors hate this? Why do investors react this way on the news, on the concession that there might be some interest rate rises in the future? The Dow Jones is down 0.45%. Those companies really aren't affected too much by this. But then we have the NASDAQ down 2.65%. If you have a portfolio like mine, the Story Fund, which is lots of these growth companies, Google, Amazon, Spotify, Facebook, Salesforce, lots of speculative companies like CrowdStrike, Peloton, DoorDash, Teladoc, these kind of smaller high growth companies. If you have a portfolio of these companies, interest rates rising is not good for them. And that's why investors are selling out. A lot of these type of companies have been the beneficiary of a low interest rate environment. They've been able to get access to capital to fund their rapid growth at a very cheap cost. Getting capital with low interest rates is inexpensive. If the interest rates go up, like Janet Yellen is kind of conceding that they're probably going to at some point, these companies will have a more difficult time getting access to capital. That is a concern that investors have, is that these type of companies like DoorDash, that they don't have the capital themselves. They aren't free cash flow positive. In fact, they lose a lot of money quarter after quarter. They need to go to the debt markets. They need to go to the lenders and say, hey, we need more capital. The price of that capital is going to go up if interest rates go up, making it so that these companies have a harder time and a more expensive time funding their business and funding rapid growth. So that is the reason that these smaller, more speculative, rapidly growing companies that aren't free cash flow positive, they're not free cash flow positive, they're selling off right now, is because investors fear that they're going to have a more difficult time growing their business in the future in a high interest rate environment. The cash will dry up. They'll have a difficult time finding lenders that want to lend to them, and it will be more difficult to expand their businesses rapidly. And if their growth slows down, what do these companies have? They're not big dividend payers. They don't do a lot of share buybacks. They're growth companies. That's the benefit of them. So if they slow down their growth, they're losing their one good attribute that investors like to see in them. And if interest rates rise rapidly, there's a chance that they could slow their growth. That's the big concern. So that's the reason that you see such a dichotomy between the different indexes. The NASDAQ holds a lot of companies that aren't free cash flow positive, that are growing rapidly, and they rely on low interest rate environment to get free cash, to get cheap money. The Dow Jones is just opposite. These are a lot of blue chip companies that have high amounts of free cash flow. They do not need to go to the debt markets to fund their businesses. They fund their businesses with their customers. They're free cash flow positive, meaning that after all their expenses, their employees, their research and development, their capital expenditures, after all that's done and paid for, they have plenty of money left over. So they are self-funded businesses that don't have to rely on the debt markets. The S&P 500 is more of a mixture, but the NASDAQ is definitely on that side of those rapidly growing companies that love that cheap money, that they use that cheap capital to push it into marketing and grow their businesses. So that's what I believe is happening. In a nutshell, I believe that this headline story of Janet Yellen saying that we might actually raise interest rates, acknowledging that inflation is happening, that the economy is booming right now, and we might have to taper that down a little bit by raising interest rates. I think that that's going to push out a lot of these speculative investments. Now, my prediction, and again, this is just a prediction, I can't see the future, but my prediction is that if interest rates really do start to go up, especially at a time that we give out less stimulus money. So if we're giving out less stimulus and we have higher interest rates, I think that's going to have a dramatic effect on the market. And I think it will end this kind of year-long speculative extravaganza that we've been on. This whole market that we're in, where people buy anything. And it doesn't matter if it's productive or not. Doesn't matter if it makes profits. Doesn't matter if it actually has earnings or revenue or an actual business. People are just buying everything, from different random cryptos that are memes to Pokemon cards, everything in between. Different SPACs, companies that are pre-revenue, that have no solid business plan. People are dumping hundreds of millions of dollars into it because there's so much easy money in the market that people don't have any concern about where they're spending their money. They can always get more. It's super cheap. Margin is cheap. Getting money from a bank is easy. They'll give money to anyone. If interest rates rise, it'll change all of that. Money will become difficult to get. People won't want to lend to you. Interest rates will be high, expensive. It'll be expensive to take out debt, and that will change the behavior of investors. That's my prediction. I think a lot of the more speculative investments will get hurt, while a lot of the blue chip companies that have really good profits, really good cash flow, are self-sustaining and they can weather any type of environment. Those are going to be where people really want to put their money. So I can see that happening right now, even in my portfolio. We can look through my holdings and my companies, and you can kind of see a breakdown here that the more blue chip the company is, the more high free cash flow, the more stable the business and proven the business is, the better the results. Companies like Google and Amazon, companies like Facebook, Apple, PayPal, Adobe, these are as solid as they get. These are really the most solid businesses on planet Earth. You don't get much more solid business models than PayPal, Adobe, Apple, Amazon, and Google. Those are the very top tier, and those ones I'm in the green on by quite a margin. The companies that are a little bit less proven, that they have lots of competitors that are taking market share, or they have a lot of different concerns they're dealing with, the ones that are more speculative, where the outcome is less determined. They might be burning through cash, right? They have lots of competitors. Even though they're growing rapidly, there's more risk with the company. Those are the ones that are struggling right now. Companies like Teladoc are being sold off. DoorDash. Peloton has come down a lot. I was in the green by a huge margin on this company, and it sold off recently. We have CLTD. I'm in the red on this one. It's definitely not a blue chip company. It's a little bit less proven. We have Spotify and Netflix, two companies that are more speculative. They're subscription companies. In my opinion, they're some of the highest quality assets in the world, but because they don't have that high free cash flow and that proven business, they're being sold off rapidly right now. So that's the breakdown that I'm seeing in my portfolio, and it makes sense. The more speculative companies that rely on the debt markets to fund their continued growth investors are becoming concerned and they're selling out of those companies and they're favoring the more blue chip, reliable companies. And we can see this even in the broader market. If we look at the S&P 500, it has a lot of companies that are proven and tested, the biggest companies in the United States. And so a lot of them make a lot of profits. These are the biggest, most profitable, most productive companies. This is up 12% year to date. It's doing great. In fact, it's one of the best indexes right now year to date. It's beating out the QQQ, which is more of these technology companies. So the S&P 500 is doing well. If we take a look at the more speculative type of indexes and funds that have been followed, we can take a look at the ARK Innovation ETF. This one is down 9.68% year to date, during a time where the S&P 500 is up 12%. So that's a pretty big difference there. Now, the question is that as investors, how do you deal with seeing some of the companies that you purchased being sold off rapidly? Companies that you were once enthusiastic about, excited about, and then you see investors racing for the exits. And as social people, we want to follow. If we see a bunch of other people scared, we become scared. If we see a bunch of other people become enthusiastic and jumping into something, we follow along. You can see that trend right now with crypto. Any crypto that goes up, more and more people follow in. Any that sells off, more and more people sell out. It's human behavior. With the companies that you're invested in, if they have good prospects, if they're growing their business, their revenue, their market share, their customer base, if they're growing their amount of subscribers, I would stay invested in the business. Unless the business itself is shrinking or the business itself is being deteriorated and the story has materially changed, I would stay invested in the business. The reason why is every great company, whether it's Google, Amazon, Facebook, Salesforce, every single one of them has suffered multiple sell-offs of over 10 or 20%. Every one of them. Even low volatility companies like Costco have had times where they sold off. If you were one of the ones that sold Costco when Amazon announced that it purchased Whole Foods, that 20-30% sell-off, you would have sold one of the best investments since then. The people that bought that dip are the people that got the rewards from it. So if you want to buy good companies, you have to expect that they're going to sell off from time to time. And if you can't stay invested, you will not reap the rewards of when those prices soar, when enthusiasm is restored. Because investor temperament changes all the time. It's rapidly changing. And Peter Lynch and Warren Buffett they've both said many times, they've repeated this message many times, that money in the market is made by people that have a stable temperament. It's not made by people that are high IQ, people that can do advanced math. It's made by people that have a stable temperament. People that can keep invested while other people are panicking. People that can buy the dip rather than selling at the lows. People that don't want to race and buy whatever company people are buying at the moment, but they wait for good value. Those are the people that make money. The people that have strong stomachs. The people that lose money are the ones that have to follow what everybody else is doing. The market's selling off today. Companies are going in the red. I have to start selling. Other people are selling, and I feel the urge to do exactly what they're doing. That is how you lose money in the market. I'll give you an example of going against investor sentiment. I can give the example of Disney in my portfolio, both the story fund and the passive income account. I've made a lot of money on this holding. Disney is one of my best performing ones because I invested in it during a time where I was going against the common sentiment of the company. Back when I bought it most heavily, you can look at the Seeking Alpha articles. They were all negative. They were bearish, explaining how the company had shut down all of its parks. It was firing employees. All the cruise lines, those were shut down. The movie theaters, those were closed. The company was reducing its cash flow. It was struggling, and it's not going to be profitable. In fact, they're losing money for the first time in however many decades they lost money. This was all bearish sentiment. Investors were urging people to be scared, to sell out of these companies, right? I thought about this and I thought, you know what? I just don't agree with them. Disney's going to be fine. They have a lot of cash. Anybody will lend them money. It's a company that has the best intellectual property probably in the world in terms of entertainment. They have one of the best libraries of different franchises and content, and they have a growing streaming business. So this company's faith, investors' faith in this company is going to be restored soon enough. Soon enough, their parks will be reopened, investors will become enthusiastic, and probably the share price will go up. That's the reason that I invested in Disney, is I went against investor sentiment, and that turned out to be one of the best performing holdings. So if you're always following what other people are doing, if because the market's selling off right now or it's selling off over the past couple months and some of your holdings are going down in price and you follow with that, you're going to lose money. If you stay invested in good companies for long periods of time, you're most likely going to make money. Now, I pay attention to how the company itself is performing. As long as these companies continue to grow, continue to take market share, grow their customer base, grow their revenue, I'm going to stay invested. If the companies themselves slow down where they're not growing, or the companies themselves have material change in their story, then I might consider selling. But unless that happens, I plan on continuing to invest in these companies. So there's my thoughts on the subject. I hope you enjoyed this episode. If you did, it helps me out to give the video a thumbs up, as well as you consider the Patreon if you want to bring your membership to the next level. That's a fun thing as well. Other than that, I'll see you guys next time.